Good day, welcome to our second portfolio considerations webinar. Just a wee bit of a reminder, some positioning. We've moved from EUGM, electronic user group meetings, many years ago. Then we went to Connect and Grow. Now we've renamed the series of what we do, Mindset Meets Mechanics. And Mindset Meets Mechanics has two main webinars that are delivered on a monthly basis every 2 weeks. Fortnightly. The one is the market update, which turns out to be monthly, and we're going to do portfolio considerations, real world portfolios webinar. And in these, I look through the real money public portfolios, SPA3 investor public portfolios, real money, real world. What I'm going to do today to position this, I'm going to do a little bit of what I did in the first one, which was the 31st of July. Now that's more than a month ago. We've had some other webinars that Dave's delivered and I've delivered in between. We did the secular bull market update, and Dave did, he's probably done 4 webinars since then. But so we're going to get into this regular routine of doing this monthly. And I will mix it up a bit. Last time I did, because they're going to be roughly a month or 6 weeks since the last one, there's going to be stumbles and the stumbles, i.e. the bad ones, and then the good ones. We'll look at those as well. But because it's so recent, I've brought something else in rather than just look at the same ones, because there's been only a few trades done. And so we'll bring some others in. We'll look at what I've called breakouts from within the range, just to show, I'll talk about it then. And also big single day rises. There've been a few in the US where there's been 15 to 25% jumps from one day to the next that have caused an entry signal. So what do you do in those situations? So we'll cover those. Before we do that, I have to tell you that everything we cover here today is general investment advice, not personal or specific investment advice, and that past performance is not a true indicator of a reliable indicator of future performance, is what I have to tell you as part of our AFSL. Right, why I actively invest. Little bit of revision. I'll go through this pretty quickly. A lot of our long-term members will be fully aware of this through all of our teachings and papers and everything we've written. But there are two big risks I see which is why I invest actively. The first one is not getting enough return, and small annualized percentages make a difference. 2, 3, 4 annualized percentage points over a long period of time means that you either have enough or you don't, depending on how much wealth you have. But I do this as an absolute number to see how what the numbers are, what are my annualized returns, and obviously that turns into absolute profits as well. So I'm keeping score of that, but I'm also doing this to keep score as well, to know where I stand and where I am on this long-term journey, and from a bigger picture perspective. How am I doing relative to how well I've got to do to have enough, if you like. And have enough for what's an open-ended longevity number that we don't know. So that's risk number one, is not having enough, the risk of not having enough returns to get enough lump sum for which to see you through the rest of your life and to maybe leave a legacy. Risk number two is which is sequence of returns risk, is that if there's a big 50% fall, that I have got that covered. How do I have that covered? Well, I'm active. That's why I actively invest, because I know not at the top, but soon after I'll probably be in cash, mostly in cash, if not 100% in cash, before we have the 2008, 2001 type bear markets, which happen in a secular bear market, which I covered in just a couple of weeks ago, 3 weeks ago. I did a secular bull market update, which I'll quickly go into the moment. And I have this recursive loop running all the time in the back of my head as a reminder, if you like, as to why I do this. What's my purpose? And of course, I've put risk number one at the top there, because that's ongoing all the time. That's what gets me to actively invest and to put a process in place that doesn't take up the whole of my life. In fact, it takes up a very little bit of my life. Why? Because I've got a mechanical process in place. But risk number two happens so seldom, and when it does come, it comes very quickly, and we're not going to know we're in it, because every big fall starts with a small fall, and we don't know which small fall is going to turn into a big fall. That is why I have to be on my game so that I do get taken out of the market. But then if this small fall doesn't turn into a big fall and the market turns around and goes up again, well, then I'm back in. So I need to have that call to action to do that. That's why I actively invest. A quote that I didn't put up last time, which I may have referred to, I can't remember, but this is a quote he made in 1957. Our performance, and he's talking about Charlie Munger, him and himself, relatively is likely to be better in a bear market than in a bull market. And that's what we are trying to do here, not by doing hours and hours of research to be in the better fundamentally strong stocks, because he spends his whole day trying to find that and has been doing that for decades. We do that using timing, using technical analysis and timing, and that just requires 15 minutes to half an hour a week to get our sell signals according to our mechanical system to call us to action to exit the market. And that's what we want to do, is to be out during bear markets and thereby get out performance. But in a year when the general market had a substantial advance, I would be well satisfied to match the advance of the averages. And it's not just a year, it could be multiple years. And that's where we want to match the advance, but make sure that we're out for the big bear markets. Now, we use trend following, and trend following, obviously, you require that to be able to be in the big rises when they continue. Mean reversion to the mean doesn't help you in a strong bull market, because you're going to get whipsawed in those. But the downside of a trend following system is that you get whipsawed in sideways markets, which we'll talk about in a moment. So this big picture recursive loop that's going on in the back of my head all the time is really trying to save me against the big red circled area over here, which is the last secular bear market in the United States. This I covered in the secular bear market update, and I do that every 6 to 7 months, and did one just recently. And you can find that on YouTube if you haven't already seen it. That's the area, that's the time we're looking for. That was 13 years that went on for, and this is zooming in on that. So a rise that's coming into the end of the secular bull market, going to the secular bear. We didn't know this was going to be a secular bear market at the time. So that is the top of 2000s. That's January to March 2000. And then, of course, we have this 49.15% drop over here. We want to be out for most of that time. Sure, there's going to be little times because we don't know that this is going to go all the way down, because every big fall starts with a small fall. But we may be in for short periods of time over here, but mostly in cash for the whole of that long bear market that occurs, primary bear market that occurs within a secular bear market. Then you have a run-up. There was 100% run-up, and we want to be in those. So not only do I protect myself in a secular bear market, which is coming, winter's coming, we don't know whether it's going to happen the next year, could even go all the way to 2030 before this current secular bull market ends. But when it does, we want to make sure that we're out for that first big 50% down leg that's going to occur in it for most of the time. But in the secular bear market, we can take advantage of the up run. There's 100% up run, and we would have our money exposed. So you miss most of that and gain most of that, miss most of the next one as well by being in cash, and then gain and then get most of the next one going up. You're never going to get it all. You're never going to miss it all. We just want to get a decent enough chunk that gives us, as Warren Buffett said, to outperform in the big bear markets, but to at least match in the rising markets, and hopefully do a little bit better depending on stock picking and other various things that happens on a more short-term basis. So that's why I actively invest. So let's have a look at some real-world portfolios. I'm going to focus more on the unleveraged here than the leveraged, but I'm going to look at three. These are three real money portfolios that I manage with my money, and this is part of the money that I have invested. I have other money outside as well that is not that follows SPA3 Investor mainly. But it's the same principles that I'm following. The objectives of doing this session from time to time, and I thank the customers that suggested it to us to do this, is to have a warts and all real world conditions, and to keep checking in on it, and to use this environment to check on mindset. So to do some mindset training, to check on my mindset, and also money management as well, and to show you that actively investing or trading isn't just made up of timing. Whereas people who come to the trading and the active investing world spend 99% of their time on timing, i.e. analysis. And analysis whilst it's a necessary part of the game, is not the main part of the game. The two main parts of the game are the two M's, the mindset and the money. The method, which is timing, is the least of those three M's. So we get an opportunity in this, using real world examples of real money portfolios, to also talk about mindset and money management as well. And also the most important thing is to talk about execution under pressure with money at stake. And that is the big difference. I'll talk a little bit more about this as well, because analysis can be done without money at stake. And we can be really good analysts when there's no pressure on. I'm a really good putter, and most people are on the practice putting green. But when there's a game or something else at stake, your score at stake, everything else at stake, then the pressure's on, suddenly you don't putt as well. And you can take that analogy to all other parts of life as well. So we have to learn to execute under the pressure of having money at stake. Right, so what we're going to do is look at some performance here. We've got nearly 8 and nearly 3/4 are years of real world execution, real money execution. And before we do that, I just want to remind you of the mistakes. There's two big mistakes we made in the US portfolio. The one was, for a period of time, about 18 months, we started up a second US portfolio, and for reasons at the time. And what happened then, we made the decision to keep them mutually exclusive. And what happened were stocks that should have been in the portfolio we were in now, which was number one, we called it number one and number two. The second portfolio got into those that should have been in the number one, and because we were using BAPS at the time, and hence we weren't taking the first opportunity that became available for portfolio number one. And that meant portfolio one ended up in cash sometimes, because we wanted to have the stocks mutually exclusive. And that led to poorer performance. And we did check that out, and we found that if we had taken all the first opportunities that came at the time of the first portfolio, the primary portfolio, performance would have been a little bit better. And the second one was a money management mistake, which when we reduced from 13 to 10 positions, we were underinvested as much as 18% at times, when we should have been 100% invested, because we had stocks that carried on trading for a long time. One in particular that went for about a year, nearly a year and a half after we made this change. So those two mistakes have put a little bit of a handbrake on the US portfolio performance. Okay, so what I'm going to do now is I'm going to look the last Mindset Meets Mechanics session, where we looked at the portfolio considerations, was the 31st of July. So first, we're going to start by looking back to see what's happened in the portfolio since then. And then we're going to look at the 1, 3, 5, 7 and inception metrics to see how they're going. I'll do that pretty quickly in Beyond Charts within Portfolio Manager. So those of you who don't use Portfolio Manager, it's a fantastic tool for doing this sort of stuff and doing other things as well. It gives you the metrics and from time to time in these sessions, I will zoom in on metrics. I'm not going to do that today, but we will do that from time to time. We'll look at equity curves, and we'll start off with recent market conditions, just to give an idea of what's happened in the market, in both the US market and the Australian market just recently. Right, so this is the recent market conditions in the SPX, the S&P 500. And you can see I've got this black, what was a resistance zone, which has now become a support zone, but that was where the breakout needed to happen. This chart goes back to July 2021, so about 3 years. And the US market is up 17.4% from that high mark over there back in January of 2022. There was the breakout above into new all-time high territory, and up 17% basically from also the breakout, because that's the same level over there. And now having a third attempt at making another new high here. So there was the previous high. So we got a swing. This is not live, so I can't show you a swing chart, but it is also an open trade, the S&P 500, which means kind of low market risk conditions, but still struggling to get above and make a new high. The All Ords is up 5.87% from its high over there. There was the breakout a little bit later, but certainly has not continued up since. And you can see here, this is the relative strength comparison between the S&P 500 and the All Ords, and this downward slanting blue line here means All Ords has been underperforming the S&P 500. And even of late, a couple of little up darts over there. There's one, but mostly underperforming. So what I'm going to look at now, so that sets the scene for the market conditions. US done a little bit better, and certainly has, since the breakouts above their respective all-time highs, have got to, the US market has gone up about 3 times more, talking about 17% versus 6%, than what the All Ords has. Recent sells in the ASX Sparta Investor portfolio. There's been 3 sells, pretty short hold periods. Flight Center was only 13 days, 6.8, 5.6, and 1.2%, and relatively short hold periods. Those are the days that, so the 31st, that ANZ was a sell the day after we did this last one. The US Sparta Investor unleveraged portfolio, public portfolio, also 3 sells. There was 1 profit trade in there, that relatively small lost trades as well. Adobe was showing promise, 50 days. You'd expect over that period of time to start showing some profit, but it had an end of trade drawdown, which means the last trend, short-term trend down was quite steep, which ended up in a small loss trade. And the leveraged portfolio has had 5 exits. Southwest Airlines, 15%. So now we're getting up to, that's when we say to people, when you do your skills acquisition plan, which I'll mention in a moment, and you're running your own portfolios and you're doing your planning and you're doing your investment plan, is look, and you're looking at your position sizes to work out whether you can handle the risk of managing your own money and trading mechanically. Is look at your position size, look at a 15% loss because they are greater than 15 or less than 15% losses, less than minus 15% losses, are rare, but they do happen. But 15% is kind of getting out there. And so look at your position size, and that turns out to be, $10,000 position sizes on average on a 100K roughly portfolio. Then that's a $1,500 loss. And say to yourself, well, how will I feel about a $1,500 loss, a 15% loss on an individual trade? Just to get an idea of, for your risk profile in the market. And then, if you've got $100,000 that you're going to put into a Sparta Investor type portfolio, and then look at what a 25% drawdown would be, straight away, $25,000. How would you feel about that? If you feel that would be too much, because now we're looking at the downside, because we're going to do risk management before we do profit management, is how would you feel about that? If you feel you would be nervous and it would be too much for you to handle, that it would stop doing the process or take you out of the market or stop playing the game, because remember, this is an infinite game, that you would put in less capital. So you'd reduce the capital until you go, okay, 25% loss on my entire portfolio, I would be able to handle X amount in absolute dollars. And that's where you would start with a skills acquisition plan. So 15% as an example, kind of a max example, bearing in mind that you can have some outliers that be worse than that. Recent stumbles, I've got a circle around around Southwest Airlines, LUV, and the leveraged portfolio, because that is a new one. The others are all there, and this is what I mentioned at the beginning, and that and we have these every month. The recent stumbles and the recent leaps are going to be much the same until one, because this is a longer term trading system, Sparta Investor. So I'll just circle the ones that are more recent, that have occurred since the last time. But those are the worst ones over the last kind of 12 months in all of the portfolios. So you can see, and there's a whole bunch of those that are less than 10%, obviously, but this is getting out there when you see the 14s and the 15%, to give you an idea of the type of risk that you need to be able to be comfortable with, without discomfort about this stopping you and taking you out of the game, that you have to be able to handle and be comfortable with. Recent leaps, and these are all the same. Open trades here are REA and the ASX, and AXP and the two US portfolios. They changed a little bit, not much, from 6 weeks ago. And CSR, LRCX, and NVIDIA are closed trades, and they were the same leaps that we had in the last session that we did as well. So AXP up a little bit, and so is REA. So those are the positives, if you like, because we don't only want to focus on the negative, but we have to be comfortable with handling the negative, which is because if we don't, we're not going to get the leaps, we're not going to get the positives. So what I wanted to do here, before I'm just now going to go back to doing the 1, 3, 5, and 7 in inceptions, and I'm going to go into Beyond Charts to do that, and we're just going to look at what the returns have been over those periods of time, and then we'll come back to the trades that are starting in the range. So we're going to Beyond Charts. Okay, I'm in these are workspaces that I have within these are the workspaces, and then I have the portfolio set up in these workspaces. So in the ASX, and I have these open all the time. So every time our Beyond Charts loads, these load automatically. So these are the open trades at the moment on in the ASX public portfolio. The longest held one is REA. There it is, 26%. And sorry, JB Hi-Fi is now up at 28. I could have put that in. And there you can see what they are. Most recently open trade, 14th of August, about a month ago, Next DC Limited, just showing a tiny bit of profit. And equity curve we'll look at, that's the long-term equity curve. And I'm going to zoom in here just to talk a little bit about, well, that's not going to show so well, about this period over here, which was when the Japanese market fell at 14% in a day. And those of you that are watching, have a think about how you reacted to that time, because it was, there's how it came out on the indices. So this here, the red line is the ASX 200 accumulation index, and the black line is the cash index, the All Ords. So no dividends included in the black line down here. And you can see that some exit signals were generated because we had less than the 9 open trades that we wanted to have at the time. But that would have caused some people that fall some angst in their portfolios. And of course, what happened, I'm just going to clear this. There it is over there. I'll just zoom in on this. You'll be able to get a better feel for it. So that's just showing the equal weighted, the SPA3 investor public portfolio. There was that drop. It is really coming off some weakness. So it is in had quite decent drawdown here. We can have a look and see what that is. And you can do all of these, calculate all of these normal charting stuff you can do on your portfolio equity curve. So we had a total of 14% drawdown there over a period of 126 days. That was in the public portfolio, and you may have suffered some drawdowns similar to that at the time. And there was we went from that sort of drawdown there, 10%, and then rose, and we're kind of feeling pretty good about it. Now we're sitting at 8%, and then whammo, went straight down another 6% there. I do know, because I've had some anecdotal feedback, is that caused a bit of angst in some people's portfolio, in some people's mindset, not certainly their portfolio, but certainly their mindset. The portfolio doesn't feel angst, nor does the market. Only we feel angst. And then look what happened after that. So if you had not taken entry signals, or you had exited stocks that you were currently holding, then you would not have had this run-up. And that is why we have got to be mechanical, because the run-up since then has been what, 12%, and that's happened in a relatively short period of time. So the market will do what the market's going to do, and it's up to us to set up our regime around within this environment in which we operate, to be able to not allow the noise to take us out in the short term, to take us out of our long-term plan. So there's a good example of how we've got to have the wherewithal to stick through some tough times in the market. You might remember back as to what the headlines were, and people were saying it is the biggest fall, and they were talking in dollar terms, in absolute terms, since 1989 in the Japanese market. But when you put it into percentage terms, it obviously wasn't. But so you got to beware of normalizing and putting stuff into proper context when people start reporting things, because they're going to try and sensationalize it. Okay, so those are the open trades. So now what we want to do is just compare, and I'd already set this up, as to how has this portfolio done since we last did one of these sessions, which is so the data we would have had at the time when the 31st of July would have been the 30th of July. So this portfolio is up 7.4% compared to 3.5. So the 3.5 in the ASX 200 accumulation index. So done a little bit better. Now we're going to do a comparison. I'm going to go back 1 year, and this, you can do this sort of stuff when we talk about having your. We're going to go 2023, so we'll do 1 year. So that's what's happened over the last year, underperforming the accumulation index, and that's 1 year. So that's not annualized, that's absolute, because it's only 1 year. You can't annualize 1 year. So slightly behind on the index then, but that's short term. And then we'll go 2021 to look at 3 years. And this is the period where our trend following system, being Sparse Investor, has struggled and I showed you the market that's been happening since July 2021, and the ASX basically sideways with a little bit of a protrusion out above the high that was achieved back in 2021, August of 2021. So struggled, trend following systems struggle in big, wide-ranging sideways markets. So that's what we've got to live with. That's what we've got to live with for a period of time, and that's what's tested a lot of people. I know that, but what we don't want to go and do is try and change the analysis to be able to do well in a wide-ranging sideways market, because the parameters would all change. They would become shorter term. The trend following system would start moving towards it, especially if you optimized it for that period of time, it would start moving towards being more of a mean reversion system than a trend following system. And I'll show you some charts in a moment as to why we don't want to do that. So the market's going to do what the market's going to do, and there are going to be periods of time where your system is not as in sync with the market as what you would like it, and that is where mindset and money management come to the fore. What we want to make sure that doesn't happen in this time is that we blow up entirely and go into portfolio ruin and don't live to fight another day. So we're hanging in there, and we know that trends come. Why do we know that? Because we've got over 100 years of data that shows, and I showed you the chart of the S&P 500, that trends is where the name of the game is, and we want to be in the game for that. Right now, so that's 3 years, and we'll go 2019 to make it 5 years, and you can see roughly slightly ahead of the index over that period of time, and then we'll go 7 years, which would be 2017, and ahead of the index over that time. So what is that? Just 1.5%. And then we've got inception, which is sitting at 2.5% over the whole period of time. So that's doing all right. And from my perspective, my money, I'm happy with that. Why? Because I'm matching the uptrends. During sideways, we're going to underperform a bit, and big bear markets, which is what we're really protecting against. We don't want that halving of our money. Right, let's go into the US. We'll go straight to see what the open trades are. So this is up to date to the US session, a bit of a down session there. Our longest trade has been going for 11 months, American Express, and the others sitting in 75% profit, up a little bit last night. And we've got 33, FICO, Fair Isaac Corp is sitting at 33. Being held for, I don't have a hold days in here. So those of you who don't know, if I want to put hold days in here, I just go right click, column chooser, and I come down to here, and I've got hold days, and I'll just pop that up there, and then you can see how long the days are being held for, and then I can click save, and that will now be saved as the layout that I want for that portfolio. Right. Equity curve, what's it looking like in the long term? You can see from here. So obviously this is a period where we got out of sync with the market. We underperformed in this period of time, and we've been kind of matching it, or have we? I think I've got one here from that period. So I've got this to the 22nd there. So that's the 22nd of September, just to see how the blue line is the portfolio. So it's ahead of the S&P 500. It's ahead of the NASDAQ, which is the pink line. There's the S&P 500 total return index. There's our portfolio. And I've even got the NASDAQ 100 total return on there as well. So just slightly below that. So it's doing pretty well since September 2022 over the last 2 years. That's equity curves. And now we will go to how's it done over the last month or 6 weeks since we last met. Kind of slightly under the market. Now we'll go to 9, 17, and we'll do 1 year. Whoops, missed that out. 17, 15. So slightly under over the last year. Let's just have a look at that just to see what the chart was showing us. That's the last 2 years. That's what I showed you, that relative strength chart against the NASDAQ and the S&P 500 total return index. So over the last 2 years, certainly outperforming. 2021, we are behind, and that's where we had the 2022. We underperformed in that primary bear market. 2019. Slightly below half, 7% below over that period of time, with the mistakes I told you about at the beginning of the session. Over the last 7 years, 3 percentage points behind, and over the long term, 1.4 compounded percentage points behind, with those mistakes in there. So that's how the portfolios have done in over those periods of time. And you can do this from time to time, at least quarterly you should do this, and maybe monthly, but I'm going to be doing this with you roughly on a monthly basis. Okay, so I wanted to, just for today's session, look at some stocks, what I've called starting in the range. And we'll look at the examples in Australia first. There's 6 examples I want to look at, and then we'll look at 3 in the US, and then we'll also have a look at the big breakouts as well, the big moves, 15, 20% moves in a day that cause entry signals in what we do about them. So let's go to, I'm going to go to here, and I've got a list of the stocks here. We'll go through those pretty quickly. Right. Sorry, just looking at a note there. We're going to go to Australia first and CBA. So you can just type this in if you're in a watch list. So I do know that I'm in a watch list. So this is CBA. Now, what I'm wanting to show here is that this is the range. Okay, so there's the uptrend and the rising market, and then we go into a sideways range. Now, we get profit trade, sideways market. So that's trend following, locking in some profits, and then we get these whipsawing trades that happen in a range trading market. And this is typically where your small loss trades and your small profit trades are, and can also be a slightly larger loss trade as well. But what happens is these are these trades that start in the range. So people will typically trade breakouts, and so they wouldn't take these, and they'd wait for the breakout up here. Now this breakout, and so you see people trading 75-week breakouts and 52-week breakouts and things like that. So 2 problems with that. One is, during these periods of time, you don't know which one of these is going to be the breakout, and you also, you'd have to have many stocks in your portfolio to be able to, in your universe, because if you're going to exclude these over here, firstly you have to pick the time frame. So I could have picked a shorter term time frame over here, and some of these would have been breakouts. And but I'm looking at this picture, which obviously now gives you a bias on what constitutes a breakout and what constitutes starting in the range. Is that you'd have to have a larger universe of stocks to get the 52-week breakouts to have sufficient opportunity to trade your money. Now, I'm not saying it's not going to work, but you could have fairly lengthy periods of time in cash as well. So that's just starting from the range, and that's CBA. So there's a break. So it was a 26% profit, and just one bar, that's mechanical, and on a fairly large drop, that's I think what happened when the Japan thing fell, when Japan fell, and sharp drop one day, just a slightly bit below the trading stop, but that happens, right? But that would have given you an opportunity to get your money somewhere else. So FPH is another one. Fisher and Paykel, and there it's so here's another thing. If you look at the range here, the range is actually quite wide on Fisher and Paykel, and so I would call this either that the range, but really the range would be all the way down to here. So you would be out there, and even within the range, so you're not waiting for this 52-week breakout up here. You get opportunities within the range with trend following to actually make some profit trades. That would probably be a loss. That would be a loss. That would be a profit. And you would have been out of it here, and you would have made a profit trade there, stopped a loss, and now you're in Fisher and Paykel when it's well below the range. Somebody trading a breakout really would not be buying this until now. And then you'd have to go, well, how far has already gone to get to the breakout? Do I take this or don't I? What are my rules around that? But this is a 58% profit. It happened within the range, and it's just got to its all-time and just made a recent all-time high. So there are, in fact, just looking at time, I'm not going to go through all of these, but because we could spend, just like to keep this brief, but you can go and look at the examples in the slide yourself, and you can download this analysis, and you can also look at this because I've saved this in my analysis, and you'll be able to pull this down. Here's another one, JBH. So whipsawing over here. There's a profit trade within the range, and this ball, maybe a small loss there. And these would probably have all been small losses, but there's a profit coming into the range. There's a profit trade coming into the range, coming out of COVID. And now we get this new entry signal, because it's certainly not a breakout in the true sense of the word, a breakout out of the range, but it's a breakout above an average true range indicator that we use. And then we had that trade, which is the 28%, took it out of the range, got an exit, and now we're in another one. And this is an open trade in the public portfolio at the moment. I'm going to look at one more Australian, Macquarie, and you'll see that this has actually been a pretty big move relative to the range, but a similar thing. So there's a profit trade there within the range, but these are 1, 2 loss trades, profit trade in the range, loss trade in the range. And now you're looking at this as going, the last 4 trades have been 1 profit and 2 losses. I'm not going to take this one. But it turns out to be the trade that takes Macquarie out of the range to a new all-time high. Okay, I'm just going to quickly move over to the US, and we're going to have a look at just 3 over here, ISRG. There's a 61% move out of the range as well. And just the other thing to notice here is how stocks, they rise and then they go sideways. They rise and then they go sideways. And they do this. It's just, that's how the cycle of how price action works. So here we are, there's a loss trade there, a profit trade in the range, another profit trade in the range, a loss trade in the range. So that's 2 each. And then we get this. And if you'd looked over here and gone, there's a loss trade in the range, I'm not taking this one. This is the one that has taken the price action out of the range, and it's still going. There's a trading stop below it. So that's 61% move from within the middle of the range. The other one I'm going to look at is TT, Train Technologies. This is a 109% move out of the range. So you can see this one sideways trend. 2020 COVID crash sideways, and you could say that, I haven't put a support line, but you could put a support zone down here, which would be, I'll just move it rather than create a new one. You could say that there is the bottom of the range, and it's moved up and down. So there's probably a small profit to break even, there's a profit trade, there's probably a break even to small loss, and then suddenly, boom, the one that takes you out of the range, 100%, 109% move so far and still going. Hopefully some of you have got these in your portfolios. I do know people that definitely have it in their portfolios and these, but this has not been in the public portfolio. And we'll look at one more on the US market, JP Morgan. There's a 44% move out of the range as well. Some out in small loss trade, profit trade in the range, another entry within the range to take you out of the range. Right, now I'm just going to, so that just gives you an idea of, anything can happen. And you would have read a lot of things that said, you wait for the trend to be up. Well, there the trend is sideways. And those lost trades that you see within the range in the sideways moving periods are all part of the edge. They're part of SPA3 Investor, and that's what makes up the 45 to 55, maybe even 60% of lost trades that occur, but they constitute the edge. Without those in there, you wouldn't be getting, if you only wanted to take trades that were outside of the range, well then you wouldn't be getting the ones that are initiated from within the range. And if you look at the number of large profit, the large moves that are initiated within the range, they are just as big, if not bigger, than the ones that are at the breakout, because obviously you've lost the run-up that's happened within the range. Now, I wanted to look at these as well, because these did cause a little bit of discussion with some people. I'll go to AZPN first. And what I'm looking at here, I'll just zoom right in, is you can see here 19.72%. So it's a closed trade, and you have, sorry, that there should go from there to there. It's a 16% move, and that 16% move on news obviously creates an entry signal. Now people will go, wow, should I take that? Because it's already got most of the move. You look at the average move of profit trades in SPA3, that's the whole move done. Well, what I want to tell you is, in our research, all of this has been taken into consideration. So the big moves that have caused, in the historical research, that have caused an entry signal are part of the edge. But when you're living it, you kind of go, well, no, I'm not going, I shouldn't take that, because it's because that's going to, I'm going to lose. Obviously, it's going to go down. Yeah, anything can happen. So I think we have this as an open trade. No, we don't. We have it in the leverage portfolio, AZPN. It's in the leverage portfolio, and it's got 11% profit with a 3% rise last night, and you can see there's that 3% rise in the session, the US session today. So just because there's a 16 now, if you would be sitting there trading, the US market, and you would get the entry signal on the app or running a scan, and you'd see there was a 16% move, and you've got available capital in your portfolio, and what do? Well, you have to take the trade. That's being mechanical. If you haven't taken the trade based on that move, well, then you are not being objective. You are breaking the rules. You're applying subjectivity. You're bringing, you're overlaying your expertise. What is your expertise telling you? You know what's going to happen. Sorry, you don't know what's going to happen. And the more you override because you think you know what's going to happen, the more you're breaking fundamental rule number 2, which is I do not need to know what's going to happen in order to make money in the market. And you can't break those 5 fundamental truths. So when an opportunity comes like this, not taking the trade is saying that you don't believe in fundamental truth number 2. I do not need to know what's going to happen in order to make money, and nor do you believe fundamental truth number 1, which is anything can happen. So another example of this is FTNT, and that had a 25% move. 25% move from down there caused the entry signal, and then we got in on the following day. This is in FTNT. There it is. We're sitting on a 10% profit at the moment, and it's also in the leveraged portfolio as well. Right. We look at, we got another couple more examples. Starbucks did the same thing. Starbucks had a 24.5% move from there. So that's just one day from there to there, entry, struggling at a resistance zone over here at the moment, but it is an open trade sitting at 2.66% net profit at the moment, and waiting to break through. Will it break through? I don't know. Do I need to know? No, I don't. If I was a subjective, an analytical trader, if you like, who changed their rules all the time, then I would need to know. So then the fact that you become subjective and you are an analyst trying to trade, without being objective, is that you have to keep on trying to predict what's going to happen based on what's just happened in the recent past. I've tried to do that, and I used to do it, but it's just, you drive yourself mad. You really do. It is so hard to do. Why? Because each moment in the market is unique. Fundamental truth number 5. And we're going to look at one more example, Exxon. Exxon had what did it have? It had a 18.39% move up to generate an entry signal. I don't think this is in, yeah, it is. It's in that we're sitting on a 3.9% profit. So all of those, and there have been a few days, doesn't mean they're all going to end up being profit trades. But the point is that to drive home those 5 fundamental truths, it's situations like this that are feel abnormal, put you into a bit of discomfort, and that discomfort gets you to distrust and not accept the risks, and to try and overcome the risks, overcome your fear by thinking you know what's going to happen just because there was a big rise. Now, I've just rattled off a whole bunch of words over there, which are, Dave and I used ad infinitum in the 4-week process and mindset training intensive. And it's also written up in the little book, from flustered to unflappable trading that I wrote as well. So these are all, the cornerstones of trading that you have to do these things. You have to accept the risks. Accepting risks leads you to being objective and not trying to override them with, what's going to happen subjectivity. So it goes, accepting all the risks means that you can be objective. Being objective means you can trust. You can trust yourself, you can trust the market, and you can trust your edge. Trust leads to confidence. You cannot be confident if you distrust. You cannot trust if you are being subjective, and you cannot be objective if you don't accept with every part of who you are the risks. So you go, accepting the risks leads to objectivity, leads to trust, leads to confidence, leads to consistency. You cannot become consistent without all those other steps in there. Consistency leads to long-term profitability. Right, to finish up, a quote. This book, some of you may have heard of Ned Brockman. He ran across Australia in record time to raise money for the homeless. And the back cover of his book says, "Get comfortable with being uncomfortable." And I like the title of the book too, Showing Up. This is a marathon man. He was running 100 Ks a day for 46 days or something. And he had to show up. And he had to show up when he felt highly uncomfortable. He had bruises and he had blisters and pain and all sorts of things. But he had to show up because he had a goal to achieve. And that goal was not for him, it was for somebody else, for a whole bunch of other people. And that's what we got to do in the market. Every day we've got to show up. We've got to show up. But the number one thing we've got to do to be able to show up every day, and so that the short term doesn't take us out of our long-term goals that we're trying to achieve, is that we have to get comfortable with being uncomfortable. We have to get comfortable with discomfort, because discomfort takes you out of the process. In conclusion, I want to mention the skills acquisition plan, which is part of the 4-week process and mindset training intensive. Now, I know we have a lot of customers that use their own portfolio management software and even put their own secret spices, herbs and spices on top of Spice Investor and Spice Trader. But for the skills acquisition plan, is not about analysis and it's not about money. It's about gaining skills. And that skills acquisition plan is, I think we introduced it in a session 3 or 4. And then obviously it doesn't conclude in the 4 weeks, but it gets you to initiate it and start it. And what we've just started up is a learn to trade properly, or the LTTP that Dave is running. He's got some 60 customers who are in that, and a continuation of the skills acquisition plan, if you like. If you or your 25 trades that you may have done as part of your inception into ShareWell systems. But the learn to trade properly is something that, if effectively what we're doing is everybody's going to be starting with an amount of money that tests them, but isn't so much that takes them out of the process. And they're all going to be in the same trades at the same time, starting soon. And Dave's running a final session on Friday before this actually starts. And there were people were asked to show their interest and join it. And there's been nearly 60 people join that. So just want to tell everybody else that's not in that, if you're interested in that, we're going to be starting another one in a few weeks' time to register your interest. And this is what it's all about, so that you can have portfolios that are similar to the public portfolios, and that we at least match the long-term averages, the indices, the total return indices, while they're rising. But at the back of our mind all the time, we're doing this so that we don't wear the 50% plus falls. In the NASDAQ 100, it was an 82% fall, in those secular bear markets when they do come. And we are certainly closer to a secular bear market than what we are, put it this way, when the secular bear market starts in anything from 1 to 6 or 7 years' time, we are going to have at least 10 to 13 and maybe as long as 18 years of sideways market. And we want to be prepared for that. And this is how we do it. So thank you for your interest and time. And just any questions. Gary just had some frustration getting in. There will be a recording of this go out today. And if there's no other questions, you can certainly ask questions on the forum and other places, and of us directly. But until the next one we do, I wish you objective, consistent, and peaceful active investing.